Over the last couple weeks, we've taken you pretty in-depth into the accounting information system, debits and credits, and began to really expose you to an entire new language. As we continue to move forward, we're going to build on that language and some additional steps and some additional things that we do in accounting. A lot of this is not intuitive, and if you are finding that one thing or another is tripping you up, please always feel free to send an email to me. I will find an additional resource for you. This is not something that everybody takes to immediately because it is a new language. It is a new way to think. As we go into the accrual accounting concepts, these are also new ways to think and new language. So be patient with yourselves. Go back to the videos, go back to the text, look at the examples. Don't let it frustrate you. We'll be talking about the accrual basis of accounting and the reason that we engage in adjusting entries. We'll be preparing both types of adjusting entries, deferrals and accruals, and we will prepare the next step in the accounting information system of the adjusted trial balance and the closing entries. So one of the reasons that we engage in adjustments and accruals and deferrals is that we have to determine a cutoff point for amounts of revenues and expenses and define given periods of time. And determining what revenues and expenses to report in a given accounting period can be difficult. Accounting divides the economic life of a business into these artificial time periods. Those time periods can be months, quarters, years, fiscal year rather than calendar years. This is what we call the periodicity assumption. Many times, transactions affect more than one of these periods. Determining the amounts of revenues and or expenses to report to each period is our challenge. So what is the periodicity assumption? Based off the book you're reading, is it companies should recognize revenue in the accounting period in which it's earned? Is it the company should match expenses with revenues? Is it that the economic life of a business can be divided into artificial time periods? Is it the fiscal year should correspond with the calendar year? Hopefully you chose C. The economic life of a business can be divided into artificial time periods. Proper reporting requires an understanding of the nature of a company's business. There are two principles that are used as guidelines in accounting. The first is the revenue recognition principle. The second, which we'll talk about here shortly, is the expense recognition principle. The revenue recognition principle requires that revenue be recognized in the accounting period in which the performance obligation is satisfied. So when a company agrees to perform a service or sell a product to a customer, it's created a performance obligation. Service companies record their revenue when the services are performed. Retail companies recognize their revenue when the goods have transferred hands from the company to the customer. So let's look at this a little bit more in depth. So we have Conrad Dry Cleaners, and they clean clothing on June 30th. But the customers don't show up and claim and pay for the clothes until the first week of July. They completed their obligation, Although the customers have not claimed the close, nor have they paid for the cleaning in June, they did complete the obligation of performing the service of cleaning for the customers in the month of June. Therefore, they would recognize as an accounts receivable saying, our customers owe us X amount of money for services completed in the month of June, and though that service is a revenue. When the customer comes in and pays for the clothes cleaning, and then they also claim their clothes by remitting cash, we reduce the accounts receivable by the amount of cash. Service businesses recognize their revenue when the services are performed. Many times, customers have to be billed for those services. When we bill our customers, we create the asset, accounts receivable. Because the service obligation has been satisfied, the revenue has constructively been earned and must be recognized. So another way to think about this is think about airlines. So on May 1st, you buy a ticket for a flight on June 15th. You've paid for the ticket in May, but you're not going to fly until June. Has the airline provided you with the service yet? No, the airline has not provided you with the service yet. They still owe you the obligation of a flight on June 15th. The airline does not recognize the revenue on May 1st because they've not provided the service. They'll recognize that revenue on June 15th when you actually take your flight. The second principle, the expense recognition principle, requires that efforts or expenses be matched with accomplishments or revenues. So the common saying is to let expenses follow the revenues. The critical issue that exists when determining when the expense makes its contribution to revenue. Expenses need to be matched with revenue in the period in which the company makes the efforts to generate those revenues. So here we have a quick little pictograph that talks about the difference assumptions and the recognition and principles that we have to deal with. Due to the periodicity assumption, so we're cutting things up into artificial time frames. It makes it more important that we go through that transaction analysis and we determine when revenue is actually earned and what expenses pair with that revenue. Invariably, of course, there are many instances where things such as revenue haven't necessarily been reported accurately. And this happens for a variety of reasons. It could be a misinterpretation of a guideline or of a standard. It could be something new that has arisen. Here we have one where Apple was required to spread the revenues from their iPhone sales over the 2 years following the sale of the phone. The accounting standards required this because Apple was obligated to provide software updates after the phone was sold. Since Apple had service obligations after the initial date of sale, it was forced to spread the revenues over a 2-year period. Of course, we all know that there's been a lot of growth for Apple. And as a result of that growth, the iPhone sales was not fully reflected in the revenue amounts reported on Apple's income statement. Now, because of a new standard that has actually come into play, we had a lot of revenue recognition guidance. We've now got a more definitive set of guidance that you'll learn about in later classes. As a result of the new standard, Apple reports more of its iPhone revenue at the point of sale. Not all of it, but more of it. Underneath the new rules, it would have been about 17% higher, and earnings per share would have been almost 50% higher in those prior periods. So as you can see, sometimes our rules that we are given, where Apple had to spread it over 2 years, the full thing over 2 years, don't take everything into consideration. We have to follow those rules to the best of our abilities. Now, in some cases, they don't make sense. 100% of the iPhone sales over 2 years really probably wasn't the best sense because the additional expenses associated with the updates didn't have an equidistant over the 2 years type of a relationship. Now that we have additional guidance, we are seeing a better reporting of revenue for instances such as Apple and some of our other tech gadget sales. In order to ensure that revenue recognition and the expense recognition principles are followed, we use adjusting entries. Adjusting entries are required every time a company prepares their financial statements. Every adjusting entry includes one income statement account and one balance sheet account. They're classified as either deferrals or accruals, and each of the classes does have 2 subcategories. We'll really get more in depth with that. But before we go into that, let's really talk about, the elephant in the room. So we're going to teach you about what's called accrual basis accounting. This is recording transactions in the periods in which the events occur. Revenues are recognized when the services are performed, even if the cash wasn't received. Expenses are recognized when they're incurred, even if cash wasn't paid. This is a little bit off from the way we think about our personal life and the things that we do. It's also off from the way a lot of sole proprietorships practice their accounting. They practice cash basis accounting. This is when revenues are recognized only when cash is received. Expenses are recognized only when cash is paid. This particular type of accounting is not in accordance with generally accepted accounting principles. Most businesses do start out utilizing the cash basis of accounting. These different types of businesses will outgrow this method when accounts receivable and accounts payables become substantial. Additionally, businesses that are practicing this type of accounting eventually will need audited financial statements. In order to have audited financial statements, if that is for a loan or some other measure, then they're going to have to eventually comply with GAAP and convert to the accrual basis for that. Companies can absolutely use the cash method. And the use of the cash method does not necessarily mean that income is being manipulated. It is a much simpler method for small companies versus an accrual basis. So let's just look at accrual versus cash. So we're using a company called Fresh Colors, and they paint a large building in 2016. In that year, it incurs and pays expenses, so the salaries, the paint costs, equipment rentals, those types of things, of $50,000. It bills the customer $80,000, but it doesn't receive the payment until 2017. All things considered, when we accrue the revenue and pair it with the expenses, we get a true visualization and an accurate representation of what efforts and expenses, or what efforts or expenses were invested in the organization and what the rewards of those were in net income. Underneath the cash basis, if we did not recognize the revenue, but we recognized all the payout of all of those expenses, then we would show a loss. Part of the thing that happens when you are in cash basis is that you are going to have these outliers that happen. You put in a lot of effort, you expend a lot of monies, you have a lot of expenses associated with a project, but because you don't get paid until the next accounting period, it actually looks more poor for the organization in the first period. What then can happen is when we collect that revenue in the next period and have no efforts against it, that period actually looks really great. There's no intentional income or expense manipulation that necessarily goes on. This is just the natural business cycle. With that, when we use accrual basis for accounting, we get a more true picture of what really happened. So what did that $50,000 really go towards? Was it just thrown out the window with the cash basis until we actually see the revenue of $80,000 in 2017? We're left with a lot of questions. So based on your reading, which one of these statements about the accrual basis of accounting is false? I'll give you just a minute to read these over and determine what you think the answer is. It should be that companies record revenue only when they receive cash and record expenses only when they pay out cash. That is the cash basis of accounting and not the accrual basis of accounting. So adjusting entries. You'll recall I talked about those just a few minutes ago. Adjusting entries, which is what our next video will be about, really talks about how we go about adhering to the expense recognition and the revenue recognition principles. We will end this particular chapter here. We'll start the next one on adjusting entries, and then we actually start working with the actual adjusting entries and continue to move forward.